All right, 30 minutes until the start of the cash trade today with nothing changed in futures. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, global spending on AI continues to boom while Alphabet attracts billions in a mega bond spree.
From Coca-Cola's consumer challenges to Ferrari supercar demand, investors wade through a wave of earnings reports.
And U.S. retail sales unexpectedly stalled in December, suggesting a more cautious consumer as the year drew to a close.
So maybe spending isn't all that great. Maybe people didn't want to buy things in the holiday. Except Ferraris?
I mean, or if you're a hyperscaler, you definitely wanted to buy chips, right?
Well, that's for certain. That's the thing that's supporting this economy, this market, and we're looking at some of them. TSMC, to be specific, those ADRs in the pre-market up 2 1/3%. Revenue jumped nearly 40% last month compared to a year ago. Demand for its AI chips is showing no signs of slowing. Now, over at Semiconductor, shares down 2.6%. Revenue guidance was just shy of estimates as it sees lagging demand for auto and industrial chips. Then there's Alphabet. It's tapping the bond market for at least $9.4 billion in British pounds and Swiss francs. Sorry, that's really confusing to say the dollar amount for two different currencies, but that includes a 100-year bond.
A century bond.
Who knows if Alphabet will even exist in a century?
Amazing. And I had an analyst tell me yesterday, it doesn't matter. That's not why people are buying it to redeem after the end of 100 years. Tons of consumer earnings out this morning. CVS guidance was below analyst estimates after saying in December that all of its business units would grow in 2026. Coca-Cola's outlook was also below estimates as it raises prices and expands its lineup to non-sugary drinks. And Harley-Davidson reported an unexpected drop in motorcycle sales as tariffs and weak demand weigh on hog. All these stocks are down in the pre-market.
A lot going on this morning. Let's start with the tech news and bring in Bloomberg Tech's Caroline Hyde. Caroline, maybe it's worth starting with this bond auction from Alphabet. I mean, it's a monster. And not only that, demand was so strong for it, too.
I mean, record amounts. And actually, the most popular tranche was the century bond, was the 100-year. They got £9.5 billion worth of orders for the $1 billion that they want to raise there. But overall, it's a record amount of sterling overall bond sale that we've ever seen in that market. It's going to be a record issuance of Swiss franc denominated debt as well. Google is just ginormous for the markets to take down, but they want to take it down. The demand is such because for the pension funds, particularly in the UK, they need that liability risk. No maturity for 100 years is great for them. They don't just need Oxford University issuing this sort of debt. They don't just need the Wellcome Trust. They want to see some corporates tapping 100-year because then it's the right kind of duration risk that they want to take on. Look, Disney did this in the 90s. They already paid it back. These debt is callable. You're not always betting that Alphabet's going to be in existence in 100 years. You just need them not to be JCPenney and go bankrupt in the interim. So there are these sort of bets, though, that at a time where we're still questioning AI bubbles, where we're still questioning how much we're likely to see the overall productivity come from these AI infrastructure bets, people are willing to bet hook, line, and sinker on Alphabet in US dollars, because they up the size there to 20 billion, and in Swiss and in sterling.
Well, let's not forget that people are willing to bet on pretty much anything in this market. I mean, Oracle
not
had $129 billion worth of demand for their issue. By the way, Caroline name drops Oxford because Caroline Hyde went to Oxford. No big deal.
Never heard of it.
Let's talk about TSMC for a second. Because on Semiconductor, the outlook wasn't fantastic, but TSMC is a different story. It's a behemoth. It's almost a monopoly, right? And they have still a ton of demand.
Phenomenal. 37% increased revenue just for the month of January. They are the tell of how strong January is. Look, last year is probably held back by holidays over in China, but this year we're seeing strength of demand from the Apples of the world, where they, of course, are putting their chips into those electronics companies. By the way, of course, it's pretty painful, those electronics companies right now with the cost of memory going up. But TSMC is the darling of the AI build-out as well. NVIDIA, they are the main maker for NVIDIA's chips as well. So this just shows that if you're doubting the AI demand, if you're worrying about a so-called bubble, but that's one side for now, because TSMC has the fundamentals.
All right, Caroline, thanks very much. Bloomberg Tech's Caroline Hyde, her program, her Oxford-educated program kicks off at 11 a.m. this morning. Now, Coca-Cola offered a sales outlook that came in below estimates as the company works to expand into non-sugary drinks. Let's discuss with Ivy League-educated Emily Cohn. She leads Bloomberg's consumer coverage. And where'd you go, to Ithaca?
Ithaca, Cornell.
Yeah.
That old institution.
Same place. All right. So seriously, Coca-Cola, very important today. I mean, Julian Emmanuel at ISI was saying, as investors rotate into these kinds of retail names, we're watching their earnings very closely. So what did Coke have to say?
Yeah, I think Coke is a very not volatile stock, and the outlook was a little bit weaker than analysts may have been expecting. I think somewhat conservative. They have a new CEO coming in, but overall the growth is pretty strong. They raised prices last quarter and managed to grow volume.
Look at this stock chart, by the way. I mean, phenomenal kickoff to 2026. That is the great rotation that we've been watching.
Yeah, I think everyone's watching consumer demand. Coke obviously also under pressure to diversify away from sugary beverages. We see a bunch of states now with SNAP waivers that will prevent people from spending SNAP dollars on soda. We have yet to see how that'll impact sales, but it's something we're watching.
Maybe the wrinkle, though, in the rotation in Coca-Cola, you look at some of the macro data. I mean, retail sales clearly stalled for this month. Coca-Cola's problems, yes, they're getting a new CEO. How much of this is about the problems that they're having specifically, Emily, versus wider retail consumer companies, food and beverage, starting to feel a pinch from a consumer that's starting to feel a pinch?
Yeah, I think we're definitely seeing that. I think people are going to the grocery store and are frustrated about prices. And where do you pare back? Soda is not the stuff that you need to put dinner on the table, but at the same time, it is, if you're looking for a little boost in the afternoon, it's cheaper than a $7 latte. So I think it's a mixed bag, and it's an interesting question for sure.
I don't think I've ever drinking a Coke instead of a coffee.
No?
No.
Yeah, I definitely.
It's not the same. It won't give you the same.
I definitely, no, for me, I mean, I don't love coffee, and I love Cherry Coke.
Yeah.
Right? Or Mr. Pibb.
Yeah, sure.
Or whatever.
It's a good way to get your fix.
And yeah, the sugar and the caffeine together give me a good boost.
Or the zero sugar, which is seeing a lot of growth now.
Yeah, but that doesn't do much for me,
no.
In terms of the speed effect.
Or the Mexican sugar, the Mexican Coca-Cola.
Yes.
That's the good one.
Yeah.
Hey, Emily, thank you so much for joining us.
Thank you so much.
Emily Cohn. Now, other earnings news this morning. Duke Energy reporting results amid extreme winter conditions and rising scrutiny of America's power grid. Let's break down the results. Pleased to say joining us is Harry Sideris, CEO of Duke Energy. Harry, great to see you this morning. And in these earnings, you talked about strong momentum going into 2026. But looking back at the most recent results, how much of the quarter was about weather, the extreme cold we've had, versus sustainable demand that will carry you through this year?
Yeah, good morning. Great to be here. 2025 was a great year for us. We met every one of our targets that we set out. Really, the efforts of the 26,000 teammates that we have here delivered above the midpoint on our earnings. We announced 2 transactions that are really going to strengthen our balance sheet for the growth that we have ahead of us. And we started construction on 5 gigawatts of new generation that's going to power the amazing growth that we're seeing across our territories. And we're really focused on making sure that we do all these things while maintaining affordability and low cost to our customers. We are all our jurisdictions are below the national average in cost, and we continue to look for different tools on how we can manage those costs using tax credits, our continuous improvement culture, AI to lower costs to the customers. So really a great year in 2025. And as you mentioned, 2026 started off with cold weather. We haven't seen this kind of cold weather for this long in a long time, but the grid held up great. Our employees were prepared for the ice storm that we had. We had 200,000 customers lose power, and we restored power to over 95% of them within 24 hours. Just a testament to our employees, but also to the grid hardening that we've done and the strength of our system. 26 is shaping up to be a great year, and we look forward to continuing our great work.
I got to say, it is very cold, and my boiler went out on Saturday night. Harry. So, we're burning fires and got space heaters everywhere. How does the grid look to you? I know you say it held up well, but what improvements need to be made? What do you think this country needs to invest in its electrical grid to keep up?
Yeah, we're seeing two things. We're seeing weather be a lot more powerful and more frequent in storms. We had Hurricane Helene a couple of years ago, which was just devastating to our service territory. And we've been at grid hardening for several years, replacing wooden poles with concrete and steel poles that make it more hardy, looking at technology. I call it GPS for the grid, self-optimizing technology that reroutes power automatically, that cuts down on the outages. Just last year, we saved 5.2 million outages from that technology, and we're expanding that across our system. So we're focused on making the grid hardened and reliable to handle those situations, but also expanding it for the tremendous growth that we're seeing with AI demand and population migration to the south in our territories. We've added almost 200,000 customers for 3 years running, which is just amazing, as well as businesses coming into the Carolinas and Florida. North Carolina was just recently named again for the third time in 4 years the #1 place to do business. We're seeing a lot of businesses come here. And then just last year, we announced 4.5 gigawatts of data centers, contracts that will provide 4.5 gigawatts of power on our grid, provide value to the communities they're bringing. And those folks were contracted to not affect the general population and our
Harry,
customers.
can you get into that? How are you making sure, because this is the hot button issue with AI data centers, right? That affordability is a problem. People are upset with energy bills going on. How are these agreements structured, so everyday people aren't paying the cost of bringing these on the grid?
Yeah, affordability is very important to us. It's always been important to us, and we've always worked to keep costs low. When we talk to these large load customers, we want to make sure they're paying their fair share. We have contract terms for minimum take payments that cover the investments that we're making for them. And in fact, every gigawatt that we sign up contractually will actually lower the cost to the customers over time, over that 15 to 20-year contract, by almost $800 million. So they are paying their share, and also by spreading their costs over our fixed assets are reducing the cost to the customers over time.
By the way, this is also affordability, very important to the Trump administration. They've made clear in the past couple of months. How have your talks with the administration gone? What do you want from them, and what do they want from you?
Yeah, affordability and reliability and speed to power are shared goals that we have with the administration. We've had many discussions with them. The one big beautiful tax bill with our nuclear tax credits that we earn on our low cost, reliable nuclear units are providing $500 million a year in savings to our customers in the Carolinas. So continuing to work with the administration on tax credits and permitting reform that helps us lower cost as we're building this generation to serve this tremendous load that we're seeing.
Is there anything they specifically asked of you, of Duke Energy, Harry?
They always want us to go faster to make sure that we're developing the power that we need to keep the reliability and doing it affordably, which is very aligned with what we do every day.
Have you considered new coal investments, Harry? I know that the administration is happy to keep coal plants running. Have you considered adding any capacity there?
We've always had an all-of-the-above strategy, and our coal assets are very valuable. They proved to be extremely valuable in this cold weather that we just had. We continue to maintain those to maintain reliability and affordability as we develop new technologies and build new facilities.
Speaking of all the new building, Harry, you disclosed in a presentation today that you have new power contracts with Microsoft and Compass for data centers in North Carolina. Any color you can give us on those?
Yeah, that's part of the 4.5 gigawatts that we signed up last year as they expand and build. Those are all under construction here in North Carolina. It's very good for the communities that they serve. It's very good, like I said earlier, that they're covering their costs and will eventually over time reduce the cost to the rest of the customers. So we're really excited about the opportunities, and we have a lot more in the hopper as well.
Hey, I want to ask just finally, Harry, about regulation. And I know it's been frustrating to a lot of CEOs how much red tape you have to wade through to build a new plant or put up lines. What about on nuclear? You have your options open, I guess, for building large-scale traditional nuclear plants. how much easier do you need the administration to make it for you to actually pull the trigger on that?
Nuclear is an important part of our company. We operate the largest regulated fleet in the country. It produces low-cost, reliable energy for our customers. I mentioned the tax credits earlier. The administration has been very supportive and looking for ways to help us move forward with nuclear. They just announced a deal with Westinghouse and Brookfield that we think will solidify the supply chain. Our current focus is expanding what we have currently, doing uprates at our current nuclear plants, extending the licenses of our current nuclear plants to run longer, and we're keeping our options open. We just filed a permit for an SMR at our Belews Creek coal site, and we'll continue to work with the administration on how we can reduce the risks from first-of-a-kind technology, shore up the supply chain and the workforce, and make sure all the financial risks are protecting our customers and our investors as we move forward.
Harry, we're going to have to leave it there. Thank you so much for joining us off the back of your earnings. I know a busy day for you. Harry Sideris, CEO of Duke Energy. Let's get a check on your future session this morning, because we are just inches away from another all-time record high. We have to gain less than 0.2% to get there. We're basically flat today, though. Everything is flat. A little bit of outperformance from the NASDAQ. Those futures up 0.1%, Matt.
All right, let's get a look at some of the single stock stories we're watching for you. Paramount enhanced its $30 per share offer for Warner Brothers Discovery, adding 25 cents a share ticking fee and saying it will fund the $2.8 billion termination fee payable to Netflix. Spotify added a record number of users last quarter, and its new free tier helped drive growth, and Ferrari shares are spiking after 2026 guidance was ahead of expectations. Ferrari up 8% in the pre-market.
We're buying Gucci, we're buying Ferraris. Everything is right with the upper part of the K.
Rich people are still spending money.
Yeah, breaking news. Coming up, Advisor Capital's JoAnne Feeney is going to join us. She sees strong tailwinds driven by continued IT infrastructure spending. She's also going to discuss her top tech picks ahead of the opening bell. Stay with us for that. You're watching Bloomberg TV.
Let's get out of high interest. Look what's making headlines around the world. Barclays is sharing the spoils after a strong year. The bank's CFO was paid $12.8 million, up 12% from last year, and the bonus pool jumped to $3 billion, the largest in at least 5 years. The payouts follow earnings that beat expectations, driven by a strong fourth quarter in the trading business. And McKinsey is handing control of its $20 billion investment arm, MIO Partners, to Neuberger Berman. About 280 employees, and the advisory business will move over pending regulatory approval. McKinsey says managing a large investment firm is no longer core to its strategy, while Neuberger plans to expand in the alternative and private market offerings that arm offers. Miami brokers once hoped New York politics would drive wealthy buyers south. Instead, they're getting rich Californians. Fear over proposed California billionaire tax is pushing tech founders and ultra-wealthy residents to snap up luxury homes in South Florida. Brokers report unprecedented demand for $30 million to $150 million properties, with limited supply pushing prices at the very top up, Dani, even higher.
Yeah.
Biscayne Bay. That's where I would go. Biscayne Bay.
You want the enclave where all the rich people are and no one can touch you?
I just want to move in right next door to Tom Brady, you know? We could throw the ball around. We could grill steaks. Does he eat steaks? I don't know.
I don't think he does. I don't know. I think he doesn't eat tomatoes. That I know. So I guess no sides for you. Okay, coming up on the show, stocks are getting rewarded and punished for heavy AI spending this earnings season. JoAnne Feeney discusses next. This is Bloomberg Open Interest. TSMC's 37% jump in revenue last month proves that companies are still spending big on AI, but investors are not rewarding all AI spenders as of late. Some of the biggest AI hyperscaler stocks are flat. Microsoft, Amazon, Tesla shares, they're all at 2024 levels versus the S&P's 18% gain. The Mag 7 and the NASDAQ have not hit new highs since October. And then there's Apple, which is behind on AI, has minimal capex, is the top performing Mag 7 stock since the S&P 500's last record. Joining us now is JoAnne Feeney, portfolio manager at Advisors Capital. JoAnne, first of all, wonderful to see you this morning. Thanks for joining us. There does seem to be this weird dichotomy. On one hand, you have an equity market that's starting to rebel, that's starting to get more jumpy on AI spending. On the other hand, you have credit markets who easily absorb a huge issuance from Alphabet, including an 100-year sterling priced bond. Does that divergence make sense to you?
You know, remember the chatter about Google a couple of years ago when AI hit the scene and ChatGPT came out and everybody said, search is dead, Google is dead. You know, we're going to see everybody use ChatGPT instead of Google. And what did Google do? Well, they had deep roots in AI. They've been doing it for a long time. They slowly integrated it into search. And now you can click on AI mode and go to full Gemini and get great results. And we're seeing, you know, Alphabet rise from the supposed ashes. And now, you know, with this debt offering being enthusiastically embraced, you know, really shows you how the market can get things wrong. By the way, I think we're seeing the same thing happen to software stocks. The market is getting it wrong. And, you know, we can chat about that. But, you know, no, it's not really a divergence. I think, you know, investors were
getting it wrong on the downside or the rebound, JoAnne?
They're getting it wrong on the downside, and I expect we're going to see more rebounding, Matt.
All right, we will talk about that more with JoAnne Feeney of Advisors Capital. She stays with us through the opening bell. Right now, NASDAQ futures are up just 0.1%. S&P futures also getting about 0.1%. We come back, we'll give you the opening bell, the New York Stock Exchange and the NASDAQ market site. Then back to JoAnne Feeney for her take on why the market is getting it wrong on software stocks. This is Bloomberg. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. Not a lot of action in terms of futures. Right now we have green arrows here, but just 0.1% across the board from the benchmark to the tech stocks to the small caps. At the New York Stock Exchange, you've got the Boyd Group ringing the opening bell to celebrate their recent listing, not to be confused with Boyd Aviation. You don't see Alan Stanwyck up there on the dais. Down at the NASDAQ market site, you've got Huntington Bank.
Wow, I should go join them. Look at what I'm wearing.
Ringing the opening bell. Yeah, you have the right color.
I think I got the memo. I should.
But you're not from the great state of Ohio.
That's true. That's a problem.
Full disclosure, my bank. And I don't see my private banker, Andy, there on the dais. But great group of people, no doubt, because that's what people from Ohio are. Just good people. Salt of the earth.
Yes, they are. Shout out to Andy from Huntington Bank. All right, Matt, I'm watching some of the tech stocks on the move this morning. TSMC, they reported revenue that jumped nearly 40% last month compared to a year earlier. It's all about the AI demand for chips. Those shares up 2% at the open. Meanwhile, on semiconductors, they're able actually to put in some gains. I'm wondering if this is actually the live trade at the moment, if I'm being honest, because on semiconductor was falling a lot in the pre-market. So we'll check on that one, but they did have estimates that were just shy. And then there's Alphabet selling at least $11 billion in sterling and Swiss franc. It must be the opening trade because it is moving, and those shares down 1.1%. It also issued an ultra-rare issue of 100-year notes in the debt-fueled race for AI supremacy, Matt.
I am looking at the shares. I'm looking at a GIP of ON equity. And
well, now they're moving down.
Yeah, exactly.
So I feel like this is more it.
Exactly.
Down 0.5%.
It's moving around a lot. These things are fairly volatile.
Yes.
A ton of consumer earnings out this morning. CVS guidance was below analyst estimates after saying in December that all of its business units would grow in 26. We're going to get the down low from Katie Greifeld. She's talking to the company probably as we speak. Coca-Cola's outlook was also below expectations as it raises prices and expands its lineup beyond Cherry Coke, which is delicious. And Harley-Davidson reported an unexpected drop in motorcycle sales as tariffs and weak demand weigh on hog. I got my Fat Bob last year, and I need to get out there and buy a new
what?
Fat Bob.
Is that
That's my
what
motorcycle.
Is that?
That's my Harley Davidson motorcycle that I bought last year.
It's
I went
called
down
a
and picked it
Fat
up in Virginia.
Bob?
It's a Fat Bob. You know, it's a bobbed motorcycle.
Okay.
But it's got like the fatter front tire because it's got the wide glide on the front.
I thought maybe the lead engineer was a large man named Bob or something.
Obese Robert is how it's often called. Cool. But I do want to get a lowrider S to maybe help out that company a little bit more. Still with us, JoAnne Feeney, portfolio manager at Advisors Capital. JoAnne, we have seen, obviously, with the SaaS-pocalypse, the sell-off in software stocks that we're going to get to, and tech stocks, a rotation into these consumer names. What do you think about that? Because they've all disappointed this morning, and clearly with concerns about the labor market and the lower leg of the K, the consumer, at least that consumer that's not in the top quintile, is struggling.
Yeah, no question about it, Matt. And when you're selecting consumer stocks, you really have to be aware of that, bifurcation between what's happening in the upper income distribution and what's happening from the middle on down. Clearly, from the middle on down, they're feeling more pressure from tariffs. They are also feeling more inflation because where they spend their money is in categories that are seeing higher inflation. And so they're definitely being squeezed, and we're seeing that in some companies. But if you look at, say, a Williams-Sonoma, for example, sort of affordable luxury, they're playing to the middle and upper end of the income distribution, and that group is doing very well. In fact, Williams-Sonoma saw a very good January, and has continued to show good sales and profit momentum. So you really have to pick your spots. A defensive position like TJ Maxx has been one of our favorite holdings. We've owned it for a long time. It pays a dividend, but it also is a place that does well because of folks' love for bargain hunting, and they are seeing good, strong foot traffic. And also, their inventory becomes cheaper if we do end up in a place where some goods aren't selling out of the, the major department stores. They pick up inventory at a low price. So
TJ Maxx is up
position.
145% with reinvested dividends over the last 5 years. Absolutely crushing it, outperforming the S&P Consumer Discretionary Index by 49%.
And it's a lot of the trend that, JoAnne, you're talking about. This desire of consumers to find bargains and deals has led to that outperformance. The Bloomberg consumer team, Lily Meyer, Max Riviera, Denise Liu, had this really excellent story about Dollar Tree this morning, that the very, very heavily discounted retailer is starting now to target more affluent type places, to try to target richer people, kind of on the same trend as a TJ Maxx might be doing. JoAnne, I wonder, as you're picking through some of these consumer names, maybe ones that have been left for dead, assuming that the lower end of the consumer isn't doing well, are there any, pardon the pun, bargains out there of different strategies that might help them target the trading down effect we're starting to see?
Yeah, it's challenging because their main, the really cheap priced, products out of a Dollar Tree might be challenging unless they can really change their inventory to attract the middle income or higher buyer. Target, by contrast, we do see as a bargain, not without risk. They've had their issues that are really unrelated to their product offering, sort of cultural mistakes, which we think they are now getting in line. They've got a new management team, and it's a very attractively priced stock, offers a very strong dividend that pays you to wait while they sort this out, and they offer high quality products for the middle consumer. So we do see them in a position to pick up some business, as folks continue to try to save on their expenditures.
Let's talk about the software stocks because they have had a tough kickoff to the year. I'm looking at IGV, that is the iShares software ETF, expanded tech software ETF. It's down like 20% year to date. JoAnne, why do you think this is oversold?
Yeah, so clearly folks are worried about the software group. In fact, I put out a commentary yesterday. We do this once a week for our clients and advisors to address this question, because as you can imagine, a lot of folks are concerned about the steep drop-off we've seen in very strong companies like Microsoft and ServiceNow and Salesforce and others. The issue that seemed to have struck the market is, oh no, you're going to be able to middle managers are going to be able to code, or AI companies are going to be able to code much more cheaply and much more quickly and displace all these software companies. It's just a fundamental misread of what software companies do. Software companies solve problems for their customers. They figure out what the business challenges are inside a company, and then they write code to solve that. And they've done this for decades. So as a consequence, right, they have proprietary data about the companies that they serve. They have industry and company-specific knowledge that they've built over decades. That's a very deep moat. And a second deep moat is that they have to integrate that software for HR into solutions for, say, regulatory compliance, into solutions for product development and billing, and just a host of other things. The big companies out there have 350 to 400 different SaaS products.
Right.
So coming in and replacing that because you happen to be able to code faster is just a misread of what the software companies actually do.
I mean, I understand it's early days. We talked recently with Mark Douglas from Mountain, who said, and he's a coder, also a CEO, who said this product cannot yet even come close to replicating what his smartest coders can do. Just makes too many mistakes and doesn't do it right. But it feels like soon enough, JoAnne, I'm going to be able to point my AI at the CRM that I'm paying for every month and say, like, watch that and figure out what it's not doing as well as it could and then rewrite a better version of it. I mean, how far away are we from that?
Very, very, very far. Because not only do you have to point out at that one problem, you then have to get it to integrate with all the other software solutions doing other things at your company. And by the way, don't forget that the software companies that already have all this established, sets of relationships and understanding, they too can use AI to code more quickly. In fact, they might be the biggest beneficiaries of agentic AI because they already know the business, they know the problems that need to be solved, they know all the integration challenges, and now they're going to have a tool to code even more quickly. And as the CEO of Mountain said, you need still very talented software engineers to oversee the development of that code. Think of it this way. You might be able to get a cheaper code done quickly by an agentic AI. But if there are mistakes in that code, and the way AI works is it's a probabilistic solution, there will be mistakes. And one mistake can cost a company millions of dollars, even as they're saving, pennies or hundreds of dollars on the code itself being a little bit cheaper. Are you going to take that risk for your company? I don't think so. So switching costs, I think, are pretty high.
JoAnne, this has been so smart. Thank you so much for joining us. JoAnne Feeney of Advisors Capital. All right, about 10 minutes into your trading day, let's get a check on these equity markets as we ever so slightly push higher. We are still inches away from an all-time high. The equal weighted measure of the S&P, that hit an all-time high yesterday after a big old rally, a rebound after last week, which I guess last week we're only down 0.1%, so not huge. Anyway, Microsoft, Tesla, Netflix, a lot of the Mag 7 at the top. Netflix gaining after Paramount sweetens a little bit of its offer for Warner Brothers Discovery. They don't change the bid price. They just add in a ticking fee to the deal price. Marriott, they had earnings. Those outperformed. To the downside, it's Alphabet leading the declines, down 2% this morning, taking away about 4 and 3.5 points from the S&P 500 after a mega bond auction that goes off without a hitch, even for 100-year bonds. The demand there looking very strong. Looking at some of the sectors, communications being dragged down this morning by Alphabet. That's down 0.7%. Consumer staples, Coca-Cola not having great earnings, those falling 0.1%. At the top, you have utilities, consumer discretion, real estate, consumer discretion, the best stock. One of the best stocks there is Marriott, which I just pointed out had good earnings. So it's this weird thing of some of the consumer names not doing as well, Coke's not doing well, retail sales were stagnant, but you still have people spending on vacations and Marriott benefits from that, Matt.
I kind of want a Coke now, and I'm not a soda drinker typically, but so much talk about it makes me want a delicious cherry Coke.
I don't think we have that.
Glass with ice.
Oh, we don't have that in the office. That's a special request.
I'm going to have to go out. All right, coming up, big tech spending shows no signs of slowing, with TSMC sales jumping last month and Alphabet raising billions of dollars to continue to fund its AI build-out. We'll talk about that next. This is Bloomberg Open Interest.
Let's get you some top calls, the analyst action that we are following this morning. First up, Texas Roadhouse gets downgraded at Truist. The firm says that high beef prices will likely last through 2027, and that will weigh on margins and earnings. Shares down 1.33%. Next up, Citi, they downgrade Under Armour to a sell, saying that the company's turnaround is under pressure. Competition is intensifying and demand is weak. The firm is cautious about its business outside the U.S., particularly in Europe, the Middle East, and Africa. Shares down a painful 18%. Finally, Arete is upgrading Snap to a buy, saying growth is being driven by higher margin subscription rather than small ad businesses, and that is limiting downside risk. Shares there up 1.8%, Matt.
I need to listen to, I think there's an odd lots about the U.S. cattle situation, because apparently the number of cattle is at a low, or at least far below historical levels.
Really?
We have the smallest herd in more than half a century. And
the weather? What's happening?
I got to figure it out. The problem is the beef prices are at a high, right? But
Right.
farmers aren't making that much money on it.
So like supply chains? I'm trying to think. I mean, there have been upended global supply chains.
I'm gonna ask Tracy and Joe,
Okay,
because
good.
this is an issue that's important. That's
Correct.
near and dear to my heart. More important probably than Google, but not for the market. Google's parent company Alphabet at a session low right now. It's selling over $11 billion in bonds denominated in pounds and Swiss francs, including one that isn't due until the year 2126. Let's discuss with Bloomberg Intelligence Global Head of Tech Research, Mandeep Singh. So Mandeep, a century bond.
Yeah.
100 years until you get your money back. I mean, theoretically. Why are they selling this?
Well, one, they really raised their CapEx guide for this year. And, now we are talking about something that's outside of their free cash flow generation range. So they need to tap the debt markets. And 100-year bond just sort of gives them the ability to finance it for much longer. And look, the stock has outperformed Microsoft by 20 percentage points in 40 days of trading. So clearly, the market really sees Alphabet is much better positioned right now. It seems to be a good time to raise money. And I think the sentiment has really reversed big time when it comes to Alphabet.
Or maybe it's just pensions and insurance that need long-dated assets, too. I mean, I'm looking at this headline that just crossed. According to Person Familiar, Alphabet has raised over $3 billion in a record Swiss franc bond sale. Does this show that this is the way that they're going to be funding the AI infrastructure build-out, that may be less of sort of some of the private capital side, considering some of the jitters, and turning to the broadly syndicate loan market?
It could, but again, I think they've been so measured with the build out of their infrastructure so far. I compare them to the other hyperscalers. One, the big difference with Alphabet is they've got their own TPUs, and they do a lot of things in-house compared to relying on chip makers like NVIDIA. And so from that perspective, whether it's opening a data center or thinking about CapEx efficiency, I feel Alphabet is much more in control than the other hyperscalers, which are more reliant on, the external ecosystem.
This has been, though, a huge shift in the biggest companies that you cover, right? They used to be asset light. They had a ton of free cash flow that they were just returning to shareholders. Now, they're using all that money to buy assets, and they're starting to issue debt to fund that as well. Like, it's a completely different investment proposal.
Yeah, and in fact, Alphabet made this acquisition of an energy company for $4.5 billion. So it just goes to show, to your point, they are not only investing in the software layer or, designing their own chips, but actually buying an energy asset. This is a company that they bought because they want to make sure they have, good sources of energy, renewable, and they want to meet their emissions targets, et cetera.
But as a result, they deserve lower valuations, right?
Again, the ROI with Alphabet, I think what the outperformance year to date shows you is market feels that their CapEx efficiency is superior to others, and the ROI visibility is higher because of the print they showed with their cloud segment. At the same time, I do agree with your broader point that, once they kind of get into this mode where they have to invest so much every year, how do you show continued ROI? And that's where there's no going back from here. They will have to continue to make CapEx investments because these chips have a life of 5-6 years. Then you have to, replace them. And so from that perspective, cloud business inherently was always, asset heavy. I think AI has made it worse in terms of the commitments that these companies have to make.
Yeah, they've created a beast they need to keep feeding. Mandeep, thank you so much for joining us. You're one of the best. That's Mandeep Singh of Bloomberg Intelligence. Coming up on the show, CVS misses profit expectations and cuts cash flow guidance as healthcare costs come under scrutiny in Washington. We're going to bring you highlights from Katie Greifeld's conversation with the company's CFO. That's coming up next.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a look at what's going on with stocks 20 minutes into the session. You're looking at the S&P 500 unchanged at 69.69, which has to be a good sign somehow. NASDAQ 100 down 0.1%. The Russell is unchanged. Who cares about the small caps? Katie Greifeld. The Dow Jones Industrial Average holding over 50,000 after crossing that milestone on Friday. In terms of the stocks that we're watching, Nvidia is down only 0.5%, but every little bit hurts. Alphabet shares are also off 2.5%, as we said on session lows after that bond sale. TSMC is up after sales grew, I think 37%. Some investors may be asking, why isn't it more? On Semiconductor, actually up 3.25%. When these numbers came out at the close, it fell in the aftermarket because I was there. Hims and Hers down 3% today. It's been bouncing around on concerns about the fact that it pulled its Wegovy rival. And then CVS Health up 1.33%. And we're going to find out right now why.
And we have to, because of that blasphemy about Katie Greifeld's beloved small caps. So let's talk about the other company she follows, CVS, reiterating its profit guidance for 2026. Katie is here next to me, the Close co-host, who also spoke to the company's CFO, Brian Newman. Katie, what was sort of the read you got? Because it affirms guidance, and there seems to be widespread disappointment on that.
That's the thing. It was interesting. I mean, it was down as much as 4% or so pre-market. So interesting to see this turnaround. I mean, the fact that it reaffirmed guidance that it gave at its Investor Day in December, analyst estimates had actually drifted a little bit higher since that time. So even though it reaffirmed guidance, it sort of missed those lofty projections. But it seems like the reaction from the sell side community is that they're being a little bit cautious here, which probably makes sense when you think about what's going on with Medicare Advantage. Remember that at the end of January, the government came out and said that they're keeping Medicare Advantage rates pretty much flat for 2027, which was a big blow to the insurers. When it comes to the company commentary, again, we spoke to the CFO about this. He said that, again, this isn't going to affect 2026. It's more about 2027. This doesn't reflect the medical cost trends. Hopefully, CMS will address the misalignment, and we'll be working on submitting comments on how to improve policies here. So that is the big unknown, and you might see some of that caution in the fact that they didn't upgrade guidance, they didn't cut it, but they kept it the same.
How important is the store, the brick and mortar business, compared to the insurance business? Because I think they still lock everything up, and there's a guy who sleeps in the one on the corner. So
yeah. Well, it's interesting. You talked a little bit about flu season, which it was a horrible flu season. I'm sure you guys felt that as well.
But increasingly, people go there to get medical needs dealt with.
Well, that's the thing. They're really proud about the turnaround that they've seen at the retail pharmacy. They're expecting growth of as much as 1%. And a lot of that comes back to the fact that when it comes to cold, flu, and cough season, basically you saw this big spike at the end of the year, which isn't great for the average person, but it means that you're going into CVS and buying that symptomatic care. So, I mean, when it comes to their three business units, there is that big question about Medicare Advantage, but you're seeing growth at all three.
I better get there and get my shot. I'm going to Disney on Friday.
Your flu shot?
I want to get, because then I have the rest of the week, right, to recover from that. Katie Greifeld, catch her later on the close for an interview with Quest Diagnostics CEO Jim Davis. That's today at 3 p.m. New York time. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger with a market that's trying to put in a second day of gains after we closed yesterday just 0.2% away from an all-time high.
Coming up, global spending on AI continues to boom while Alphabet attracts billions of dollars, including one for a century bond.
And no shortage of demand for it. From Coca-Cola's consumer challenges to Ferrari's supercar demand, investors wade through a wave of earnings reports.
And U.S. retail sales unexpectedly stalled in December, suggesting a more cautious consumer as the year drew to a close. For more on that data, Stuart Paul of Bloomberg Economics joins us here at the desk. And all right, so let's hear first what the consumer actually did, and then about the outlook, because consumer confidence is very bad.
Yeah, so spending on control group sales, retail sales in the control group, so stripping out some of the most volatile items, declined 0.1% during the month of December, a dismal report. Where they were spending was a little bit online and a little bit on food services. The things that are most tariff exposed, big durable goods, created most of the drag during the month of December. Looking ahead, look, like when I see 2026 real spending growth estimated or forecast to be about 2% year on year this year, it just looks too high to me. Consumers are already stretched thin with about a 3.5% personal savings rate. Demand for credit, as reported by bank executives, is declining. It's just really difficult for me to see a consumer-driven expansion this year.
Does that mean, because we've had a lot of people come on this show and say, start of 2026, we're going to get a big sugar rush, one big beautiful bill, all these tax refunds coming in. Is it more likely then that the tax refunds are just saved, considering some of the data we've gotten?
I wouldn't be surprised if a lot of the tax refunds are saved. I also think that even if we were to see a little bit of a bump early this year because of those tax refunds, the fundamentals here, the weakness that we see in income growth and the pace of hiring, those weaker fundamentals just, again, expose this idea that there can only be so much of an expansion driven by consumers. Instead, if we are going to see anything like 2.5% or 3% growth this year, let alone 15% that President Trump wants.
2.5% or 3%.
I know, what a pessimist.
Yeah.
But if we were to see anything like that, it would have to come from fixed investment. It's not going to come from consumption.
So talk to us about President Trump's declaration that Kevin Warsh at the Fed could lead to 15%. I'm assuming he means real GDP growth, but even if he's talking nominal, like how likely is that?
15% nominal growth, if it were to come from anything, would be coming from inflation and would be very, 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 very bad. 15% real growth is just something that's so far outside the realm of plausibility, let alone possibility, that it's not something that we're ever going to see in our lifetimes. Beyond thinking about the expenditure side, consumption plus investment plus government spending and net exports, if the president's thinking along those dimensions, it's a relatively narrow scope of analysis. He should be thinking from the supply side, how much can we actually grow our capital stock? How much can we actually grow our population? How much are we going to see in terms of efficiency gains? And from the supply side, we can't see anything close to 15%.
I mean, you say that, but he knows more about the economy than anybody.
That's true.
They might know more about jobs numbers than anybody because they've seen them. And I just want to say, adding to what we heard from Kevin Hassett yesterday at the NEC, Peter Navarro, the trade advisor, was on Fox Business this morning. He did say he's not expecting weak job numbers, to be clear, but he said we need to revise expectations on the monthly jobs numbers, and that deportation of workers will be influencing jobs data. It does have a feeling of a White House that's trying to prime us for something, if you are of the conspiracy theory ilk that they look at all the numbers and try to set expectations.
I am a little bit of that ilk.
So are they?
I think that the consensus estimate of 70,000 is way too high. We're closer to about 15,000. I think what most forecasters and economists are missing is this idea that at the Bureau of Labor Statistics, they're re-benchmarking all the data for 2025, preliminary from March through December, and the final re-benchmarking up to March. They're also going to be adjusting their birth-death model, which is going to take a lot of the steam out of the monthly numbers that we've seen. We expect that the re-estimation of the birth-death model is going to lower the typical monthly flow of job creation by about 30,000 jobs. So when we start understanding that there is a new normal for the pace of job growth, it's going to be closer to probably 10,000 to 20,000 jobs per month, not 50 to 70,000 jobs per month like we've been seeing.
I just want to point out, so it's unusual to have a Jobs Wednesday, right?
Yes, that is. Yep.
However, the Whisper Go function is still working. So if you type WHIS Go on your Bloomberg terminal, you can click on change in non-farm payrolls, and then you'll see the survey number is 68,000. Right now, the Whisper number is 40,000. But for those of you playing at home, you can play at home. Just put your guess into a box, submit it there, and you could win cash and prizes.
I don't think that's true.
No, you can't win cash and prizes, but you will win accolades from your colleagues. Do you actually enter a number? Are you allowed to enter a number, Stuart?
I don't enter a number into the Whisper function. Instead, you can find our forecast. If you go to NFPT change ECOS, you can see our forecast.
So there's nothing
Wait,
in
NFPT
CH index.
CH. I got you. Index.
That's the monthly change in non-farm payrolls, and all sell-side forecasters submit right there. You could pull up everybody's forecast, including our own.
All right, cool.
Nothing secretive in whispering about the team at Bloomberg Economics. Stuart Paul, thank you so much. I still have Navarro on the mind. Stuart Paul of our Bloomberg Economics team. Joining us now is Anne Miletti, Allspring Global Head of Equity Investments. And it does feel like we're on this string of not so great data. The jobs figures last week weren't great. Retail sales are stagnant. Have you rethought at all about the consumer and the spending power and their ability to keep fueling this economy and this equity market?
Yeah, I think some of these numbers do make us question whether or not the consumer can really be the power force behind growth in 2026. But I do think corporations are going to be powering through on the CapEx side. And we're seeing that from all the estimates and from what we're hearing and seeing during reporting season too. So I think that spend is going to be real. From the consumer side, I think you and Matt stated appropriately that we might see a little bit of a sugar rush here in the beginning part of the year as those tax returns start to come in. But I think it's going to be a little bit up and down overall for consumers.
So have you participated then, Anne, or have your clients participated in this rotation out of tech stocks and into staples or consumer discretionary stocks?
Yeah, Matt, I think this is something we've been telegraphing probably a little early in 2025, and it really did start to take effect later in 25, where we started to see the shifting underneath the surface. So while everyone was still focused on technology, what we started to see is real performance and fundamentals shifting in a positive way to other sectors and certainly below the large cap into small and mid cap. And so who cares about small cap? Matt, we do. And I think investors do too. I think this broadening out of the market is actually really, really healthy. And it does, while there's concerns, and there will be at this part of the cycle, there's some real positive data too, including the broadening, but also some macro drivers that we're looking at. ISM manufacturing numbers look really positive. I also was looking at the transport index this morning. I used to cover trucking. That looks really positive. And so when you look at areas like industrials and cyclicals, and even more on the value side, that part of the economy seems to be working really well right now.
I guess the issue, though, Anne, is that narrative combined with, yes, we're getting a lot of spending when it comes to things like CapEx, but a consumer is still weak, too. Is there a concern that just the very pillar of the economy, the reasons that we're doing well, because we're spending on AI and the top echelon of consumers keep spending, that's just like a very narrow pillar. And that means it's risky. Does that not threaten a lot of this broadening out trade?
I mean, I think there's a couple of different things going on, Dani, and look, it's a good question. I live in the Midwest, so I live in kind of the heart of manufacturing. We are seeing that manufacturing shift come back, and jobs in certain areas of the market. The demand for jobs is real in those areas, while in areas and in industries like our own, there's definitely softness coming and going on. So there's a lot of different mixed signals which we're paying attention to. So yes, the spending on AI, which could threaten job growth in the future, is probably real, but I don't think it's here yet. And on the other side of things, this pulling manufacturing back to the US has been somewhat of a positive and is leading to positive results for some broader companies. And then also just say AI adoption, or what we would call AI 2.0, where companies are spending to really figure out how to improve their businesses over time is also real. And that's actually causing, again, better fundamentals, better free cash flow too over time for many more companies than just technology companies.
You know, you mentioned the transports. I haven't looked at them lately, and they're really outperforming. I mean, the NASDAQ 100 is unchanged year to date, basically, and the transports are up 15%. I look at the transport index over the last 12 months. It's up 24% with reinvested dividends, so total return. What's driving that? No pun intended.
Yeah, no, I think, Matt, look, there was a real pullback post-COVID, right, in the transportation sector. And you saw it pull back with manufacturing. And ISM data looked pretty horrific for a long time. And, you know, tariffs, other things then held back the idea for companies to spend and go out and do more. And so I think what we're seeing now is a little bit more of a shift toward, okay, we're getting engaged. We may not know where tariffs really fall out longer term, but we're getting more comfortable that we know where the average will be. And that's I'm kind of speaking for the general sentiment we're hearing from companies. And so they're going out and spending. And so that corporate activity overall is driving both the manufacturing data, but also the transportation data as well.
So does this confirm, I mean, is this Dow theory, Anne?
I mean, I'm a bottom-up stock picker by trade, but it feels like it to me, Matt.
All right, very cool stuff. Anne Miletti of Allspring, she runs their equity business there. Thanks so much for joining us. Let's get a check on what's going on in the broader markets now. In terms of, you can see the small caps gaining a little bit more than 1%, and they do matter to all of us. S&P 500 picking up some steam now, adding about 20 points to 69.83. So getting closer to the all-time closing high, I think 69.84 or around thereabouts, and even the intraday high, which was 7,002.
Yeah, closing 69.78. So yes, getting closer to that. By the way, with small caps, I think about this thing that Dan Greenhouse from Solus said all the time, which is basically like, do you even know what's in there? And I think a lot of people don't. Like, if you look at the list of companies, it's a lot of unprofitable names, companies like Vroom.
On the Russell.
Yeah, on the Russell 2000, which I'm sure is fantastic. But I think it's important to not just love small caps as a whole, but to say what's actually in there, to defend your skepticism.
Thank you. Thank you so much.
That's what I'm here for. All right, let's look at some of the single name stocks that are on the move this hour. Coca-Cola has offered a sales outlook that came in below estimates as the company works to expand into non-sugary drinks. Those shares down 1.5%.
Harley-Davidson unfortunately reported an unexpected drop in motorcycle shipments, and that's because I have been lazy. But also weak demand from the rest of the country and tariff costs globally. But Harley shares actually coming up about 2/3 of 1%.
Maybe there's redemption for, who's it, Fat Bob?
Fat Bob.
Fat Bob. Okay, Paramount enhanced its hostile offer for Warner Brothers in an effort to woo shareholders to back its bid from a rival one from Netflix. But important to note, they are not increasing the $30 offer price. It's just a ticking fee that they've added to this.
Ah, the old ticking fee.
The old ticking fee. So Larry's still not ponying up more for the shares themselves.
It's David.
David, thank you. No, well, Larry's backstopping it.
That's right, but David does the ponying up, and then Dad just writes the check.
Okay.
Yeah.
So it could be either way.
Yeah.
He's not wrong, technically. We're going to continue to follow this deal. It's going to be one of the top ones we're going to be tracking tomorrow. Matt, have you heard? A new show, Bloomberg Deals, every Wednesday, 12 p.m. New York time. And yeah, we have this deal. We have an interview with Bill Ford from General Atlantic. We'll be talking to Holden Spat from Thoma Bravo on software. So an excellent show.
Also, really cool to have, like, this will probably be the only time you ever have your Wednesday Deals show on Jobs Day.
Oh, that's so true.
So you'll be able to ask them all.
And you know what? We have a panel about the consumer and consumer investing. So perfect timing for Jobs Day.
All right, let's talk about Alphabet, or let's focus in on that when we come back, because Google is selling bonds in sterling, in Swiss francs. Tom Keene is having a field day today because they're also putting out their first century bond since the .com era. That is for a company, of course, Austria released a century bond only a few years ago. This is Bloomberg Open Interest. Let's get now to high interest. Look what's making headlines around the world. McKinsey is handing over its $20 billion investment arm, Mio Partners, to Neuberger Berman. Around 280 employees will move with the business pending approval. McKinsey says running an investment firm is no longer a priority, while Neuberger Berman plans to grow Mio's private market offerings. U.S. Commerce Secretary Howard Lutnick is testifying before the Senate subcommittee and said he only had 10 email exchanges with Jeffrey Epstein. He says he barely had anything to do with the convicted pedophile, although he did visit Epstein's private island in 2012. He doesn't remember why he went there. Goldman Sachs CEO David Solomon says last week's sell-off in software stocks tied to AI fears was likely overdone. He spoke at a UBS conference.
We have software exposure, but I'd say it's insignificant in the scale of our overall platform, but it's certainly something that we're monitoring. I think the narrative over the last week has been a little bit too broad. There'll be winners and losers, and plenty of companies pivot and do just fine.
Alphabet is ramping up global borrowing, selling more than $11 billion in UK and Swiss franc-denominated bonds, including a rare 100-year note. Demand was massive, with record orders in sterling and francs. The cash will help fund Alphabet's huge AI spending plans, as capital expenditures are set to double this year, although some investors warn that ultra-long debt can signal market peaks.
Yeah, I think the last time we had a tech company do this was in the dot-com boom, so take of that what you will. Let's get more on Alphabet's global debt binge with Ronan Martin, Bloomberg credit market reporter. Ronan, clearly a lot of demand for this. Where is it coming from?
Yeah, I think it's coming from all parts of the market. Cash has been flowing into credit and kind of credit funds all year long, and there's so much demand and interest. Alphabet's deals in sterling and Swiss franc were debuts for both. So obviously the kind of sterling market, which last year was quite underloved and is kind of turned from one of the big kind of debt-raising markets into maybe a bit of a smaller market, is the investors are clearly lapping up this interest. 5.5 billion sterling raised there, and as you guys were saying, record demand overall for the deal. And then huge demand coming in at the long end. 1 billion raised on a 100-year note is frankly unheard of. And then the Swiss franc market has really been opening up to global companies. Companies are using it to diversify their funding, kind of move away from just the dollars and euros that they usually do and tap another market. And investors there are clearly loving this as well. It's a record corporate bond size for them.
I wonder, is this a sign, Ronan, and from conversations you have with investors, do they tell you that everything's cool, there's no AI bubble, they have a lot of confidence in this business and the returns? Or does it tell you that investors want to get their hands on any fixed income products that they can, record tight spreads, and they're willing to take more risk than they otherwise would?
Well, it's an interesting one because, like you say, the risks are there. And a lot of investors I speak to, the bearish ones are particularly loud on this, is that you're really not getting paid for the risk. The spreads are so tight, and the kind of risk we have swirling around globally maybe aren't being reflected in the spreads. But there's simply so much cash flowing into fixed income, and that's being driven by the yield they're being paid. People are being paid pretty well to invest in this stuff. And you can debate over the 100-year bond, and Michael Burry had some views on it, tweeting about it. But some of the other tranches, it's an investment-grade company. It's AA plus rated even. It's very, these are good quality deals, and investors would argue that, well, maybe you get some price moves, maybe you get some spread movement if we do see a bit of a blowout. But these are good quality bonds. You're going to get paid back eventually. You're going to be kind of clipping a decent yield and coupon off of them for the foreseeable future. So maybe they are a good investment. It's whether the kind of sheer size of the AI debt raising that needs to be done by these hyperscalers changes that dynamic. But we'll have to see kind of when we see further deals come.
And maybe if equity prices have run up as much as they are, it makes sense to shift, to rotate into the corporate bond market. Ronan, thank you so much for joining us. Bloomberg's Ronan Martin. Still ahead, what if AI could predict the success of a clinical drug trial even before it starts? We're going to talk to Dr. Raza Bokhari, the CEO of Medicus Pharma, about the future of drug development. That conversation coming up next. Stay with us on Open Interest.
get a check on the stock market right now. We're looking at some gains, but it's been a choppy ride. Just slightly higher, up 11, up 12 points right now. The breadth is good, 335 winners, 167 losers, but you can see we've had a little bit of volatility on the way up. Microsoft at the top of the heap in terms of winners. Microsoft, Amazon, Tesla, Broadcom, Netflix. So all these tech stocks coming back and doing well today. Oracle also. But NVIDIA is down 0.2%. That's good for a loss of 3.5 points. And Google is also trading lower. You can see Alphabet down about 1.6% after that massive debt raise. In terms of the breakdown along industry group lines, consumer discretionary stocks are still doing the best. Utilities, materials, and financials up as well. The losers are the communication services. That's the Alphabet trade right now. Those are the hyperscalers, as well as energy, consumer staples, and healthcare. Still ahead, the CEO, speaking of Medicus Pharma. He's going to talk to us about AI and how they use it in terms of drug development. Next, this is Bloomberg Open Interest. Biotech is entering the AI area. The technology is transforming how drug therapies are discovered, tested, and sold, and that's where Medicus Pharma comes in. The company develops new medical treatments and partners with larger drug makers to bring them to market, and it's using AI-driven data tools to run these clinical trials faster in hopes of cutting development timelines and therefore costs. Joining us now with more is Dr. Raza Bokhari, head of Medicus Pharma, as executive chairman and CEO. Doctor, thanks so much for coming on the program. Tell us a little bit of the backstory. How did you get into this? How long have you been working with AI, and how has it helped?
Thank you so much for giving us this opportunity. We are an emerging biotech life sciences company advancing novel therapies for what we believe could be disruptive assets. And we have been, I and the team, that we have been in drug development for quite some time. And we feel very fortunate that we are ahead of the curve, inspired by leaders like Stefan Bunsel of Moderna, that where we are using artificial intelligence and machine learning in making a capital efficient and time efficient drug development effort and improving patient outcomes.
Dr. Bokhari, can you explain to us how that actually works? Because I think a lot of people are used to the idea of AI in the context of pharma being used for drug discovery, less so when it comes to clinical trials. What exactly is the application? What's it doing?
So we have partnered with Reliant AI, that is an AI generative AI company, and using their robust model and our proprietary data, where we can, in our phase 2 study, can utilize AI to, number one, do dynamic site selections. Number two, we could do some pharmacodynamic informed patient stratification, and also utilize some simulation models that could help us predict geographically where patient recruitment would be better than in other areas. We are getting ready to run a global trial in a novel study to prevent relapse of acute urinary retention patient, primarily due to enlarged prostate. And this is a global study covering 390 patients. And the old-fashioned ways just are cumbersome and costly. So we're very excited that we're breaking some new ground in this area. And we find success in this first phase. We then hope that we can also use AI for adaptive clinical designs and also predict decision-grade data outcomes. So we really believe that we are leading the way in this effort.
Doctor, I spend my day looking at stock charts, and You know, when I hear you talk about your research, your trials, your use of AI, it all sounds very positive. But when I look at the stock chart and see Medicus shares down, look, 1 year, 63%, it makes me wonder what investors are missing here. What do you want to say to investors on Bloomberg?
The biotech sector is, I think, largely impacted by a lot of macro environment, and in a micro cap company, which is pre-revenue, we become the first victims of any time there are macro shifts. But patience is a virtue. We are investor operators. The insiders, with myself in the lead, have $18 million invested at $4, and we are very bullish as we enter 2026 with a lot of phase 2 catalyst. We have an AI drug-enabled strategy, and we have regulatory optionality. So I think as we demonstrate execution in the first half of this year, the investors will reward us as they rewarded us at the end of first quarter of last year when we gave our interim analysis for our novel therapy for non-melanoma skin diseases, especially basal cell carcinoma. So I really appreciate you giving me this opportunity to address our investors.
So a lot of what you're doing, again, is adding portfolio companies, adding novel treatments to Medicus Pharma. But we're in this moment right now where we're approaching a patent cliff for a lot of big pharma. And a lot of M&A is happening because of that. They want to get their hands on novel medicines like you are to make sure that their bottom lines aren't hit. How competitive is it when you're looking for new assets? How competitive and difficult is it to get some of these things, especially when you're competing with the deep-pocketed giant pharma companies of this world?
The good news is that the giant and big pharma is more focused on late-stage development and commercialization. We as a company have picked a niche and a vertical where we are taking these assets, select assets, through phase 2 proof of concept studies, and with a decision-grade data readout, partner them and out-license to big pharma. So we fill an essential component of drug development that is there to enable and complement the work of big pharma, which is more and more moving into late-stage development and commercialization. So we find ourselves very fortunate that we remain disciplined. And we also have begun to rely on machine learning, also in target in asset acquisition. So the key is to be patient, avoid temptations, and continue to double down on time-honored beliefs.
Doctor, we're going to have to leave it there. Thank you so much for joining us. That's Dr. Raza Bokhari of Medicus Pharma. Coming up on the show, Ferrari shares jumped the most in 6 years, following better than expected earnings guidance, setting a high bar as Ford prepares to report results after the closing bell. We're going to talk about cars. That's coming up next on Bloomberg Open Interest.
Aston Martin Aramco F1 team owner Lawrence Stroll is cooling expectations for the upcoming season, saying race wins will take time as the team adopts to new rules. I spoke with the billionaire yesterday.
We don't really go in with expectations. We're going to try our best, do the best we can. I'm quite confident with the team we've put together and the partners I've just mentioned that we'll do a great job. You know, this set of rules is here with us for 5 years, so it's not about the first race or two. It's about the next 5 years. Again, extremely confident we have the right people, we have the right tools, we have the right processes, we have the right partners. So I'm very confident extremely confident for our future.
We have seen reporting that Mercedes and Red Bull have found some kind of edge with variable engine compression. It's all very technical. Some have accused them of cheating like animals, I think was a quote I heard. Others have defended them. Christian Horner came to their defense. What do you think about people looking for an edge in the rules ahead of the season?
Listen, you're always looking for an edge in the rules, and you're always looking to find loopholes. That's part of Formula One. I'm not a technical power unit guru to really give an opinion on exactly what they've done, but I will leave it to those who are in the know. Obviously, there's a lot of talk going on between the various power unit teams and the FIA to check the legality of what they've done.
How about your confidence in Adrian Newey? Obviously, everyone's very excited to see what he can do with your team, and other teams have looked with a little bit of wonder and awe at the suspension, for example, that he's been able to create. What do you think are your biggest advantages with him?
You said it. It's having him. He is the GOAT. He is a unicorn. Nobody has a track record like he's had since his times in Formula One, winning 25 world championships. He is unique. There's one Adrian, and I am very blessed that he's my partner and with our team.
That was Aston Martin Aramco F1 team owner Lawrence Stroll. He and the team face challengers, including General Motors, with Cadillac and Ferrari, which just unveiled its foray into F1 with a splashy Super Bowl commercial featuring a new car. I spoke with Dan Tauris, the CEO of Cadillac F1.
Barcelona was mostly shakedown, so it's testing a lot of new systems. Everybody's talked about the fact that it's a new chassis, so a new set of regulations, new tires, new power units. But for us, for Cadillac, we're building everything for the first time, the fuel system, just all the pieces on the car. And so a lot of it was just reliability focused. As we go into Bahrain this week, we're very excited to now start to push the limits of the car and just see what we have.
You have incredibly experienced drivers, right?
Yep.
And Valtteri Bottas and Sergio Perez. What did they make of the car? And, what kind of feedback did you get from those superstars?
Well, I think some of their feedback's similar to the other drivers. There's a lot less load under the set of regulations on this car, which just means there's less downforce. The car's going to feel a little slippier to drive. And it's going to be a whole new technique as they figure out how to use this power unit with the electrification piece and the combustion piece, combined. So again, it's a very different car to drive this year. And so everybody's in a big learning curve right now.
And I mean, to that point, to that learning curve, you're a newcomer in this space. I know that you've said previously that you want to be America's team in F1. And I wonder, what you see that looking like if your vision is actualized.
So it's really leaning into a new fan base. If you think about the success that Drive to Survive has had, or F1 the movie, which just crushed every record, it's created a lot of F1 curious fans in the U.S. And that was really the thought behind the Super Bowl commercial. It's a big stage, and we wanted to get to people that don't maybe consume F1 every day. If I want to speak to the diehard motorsport fan, it's very easy to. That media ecosystem is very developed. The Super Bowl let us create a conversation about Cadillac Formula One to people who, like I said, saw the movie, thought it was interesting, and say, wait, this team's going to be on track in 30 days. I need to check this out.
Well, that gets a little bit to what I was wondering, which is why a Super Bowl commercial? I mean, you take a look at some of the numbers. On average, I believe Super Bowl ads were $8 million. We heard some reports that they got to $10 million for 30 seconds. I mean, why was it important to sort of have your debut at the Super Bowl, so to speak?
Yeah, it's really just that big audience. I think it's also just, it's this cultural moment in sports. The Super Bowl has become so much, about the ads as much as the game, depending who you talk to. And again, so this let us have that platform to reach the F1 curious, to reach a new fan base for Cadillac Formula One, to say that we're coming. And it lets us kind of put that American spin, this bold American team. I mean, what's more American than showing your first ever livery than at the Super Bowl?
And that was the CEO of Cadillac Formula One, Dan Tauris. Turning to another key player in the racing world, Ferrari issued new guidance for the year that beat expectations, sending shares surging the most since March of 2020. Let's get more with Michael Dean, senior European automotive analyst and avowed car guy at Bloomberg Intelligence. Michael, what do you think of the Ferrari numbers? I know you were at the Capital Markets Day that really brought this stock down so much last year.
Yeah, very good set of numbers this morning, and much needed because, the share price is down over 40%. And part of that was because of the Capital Markets Day. They had underwhelming targets for 2030. Management probably focused a bit too much on their electric BEV, which is just about to come up, and probably not enough on the V12s, the limited editions, the specials, which drive earnings. And it was these cars that drove the 4Q earnings today.
I should just say, I was complaining about this to Matt, that their livery was horrible for F1. It was really bad. Too much white on it. Anyway, that's a completely separate problem. When it comes to Ferrari, what distinguishes Ferrari from Porsche, for example? The fact that Ferrari has been so successful while the other luxury car maker has just been lagging behind so much.
Well, certainly volumes. So Ferrari sells 14,000 units or slightly under that a year. Porsche, 300,000 units. So it's the scarcity value, it's the pricing power. So in the fourth quarter, the average price of the Ferrari was 470,000 euros. The average profit per car was 220,000 euros. So it's very unique in its pricing and earnings power.
You know, Porsche, like Ferrari, is embracing technical prowess over mechanical intimacy. Both of them have fully digitized, computerized, electronic cars. Even the gas motors all have turbos, and they limit, Porsche limits the amount of mechanical stick shifts that they sell, whereas Ferrari doesn't even bother. I suggested to Lawrence Stroll that he just go the other way, that he put 3 pedals in all of his cars and get rid of the screens and embrace the analog. He kind of brushed that off. But why isn't any major car maker doing that, Michael?
Well, you know, cars are very high tech now, so the ability to update the software you know, makes them timeless in many sense, which has been interesting with the Ferrari Luce in that it's kind of gone a bit retro in its interior design for its new battery electric vehicle. So I think that's very refreshing, and it's quite cool, actually.
But they only put 2 pedals in the box. Like, why don't... And by the way, the most expensive Porsches have a stick, right? It's only the mainstream humdrum 911s that get nothing but the PDK. Why don't they, certainly Ferrari could sell at a huge premium a stick shift version of whatever they're calling the Roma now?
Sure, that's certainly a possibility, but the electronics do help in terms of making it more drivable. But I agree. The Porsche 911, the stick shift versions, are the most enjoyable to drive, and they attract very high prices and are very profitable. So maybe that's something Ferrari's missing here.
All right, I keep beating this drum. Michael Dean, thank you for beating it with me. Michael covers cars for us out of London at Bloomberg Intelligence. Now, it's Ford's turn to report results. That comes after the closing bell. Investors will be looking for guidance for the year ahead as the car maker scales back its money-losing EV efforts. Joining us now to talk about this is Bloomberg's autos reporter Keith Naughton. And for this company, it's all about the trucks, right? And the large SUVs. That's where the money is made. How do we expect them to do?
You know, the fourth quarter was going to be rough because they had that supplier fire that interrupted production of their best-selling F-150 pickup trucks. But looking forward into the new year, analysts are seeing them having earnings before interest and taxes of upwards of $9 billion, which would be more than the $7 billion they promised for last year. So with this ability now, Trump has lifted, you know, so the cash penalties for not meeting fuel economy and emissions regulations. With that gone, Ford can sell as many big SUVs and pickup trucks as they want to and make gobs of money doing it, Matt.
Yeah, he's called it a multi-billion-dollar opportunity, Keith. So what changes should we expect in these earnings? Did he just hike the bar very high for Ford going forward?
Yeah, I mean, they really have this unfettered ability to build and sell their most profitable vehicles. They haven't had that opportunity in a very long time. This is one reason why Ford stock is up 47% over the last 12 months. What we're seeing is legacy automakers having this rare regulatory reprieve that gives them an opportunity to make a lot of money in the near term.
Absolutely crushing it. By the way, they're not going to build the new generation EV truck in Tennessee. And they're not going to build the 3-row EV there. We've known for a long time it's canceled. What will they make there, Keith? What are we expecting Ford to put together in Blue Oval City?
Yeah, so what they have said is they're now going to make a gasoline-fueled traditional pickup truck, but it's not one, Matt, that exists in their lineup right now. And you know they have small, medium, and large, Maverick, Ranger, F-150, right? So they're going to build what they describe as an affordable pickup truck at that factory in Tennessee, their first all-new assembly plant in 50 years. So we're all sort of waiting to see what that is exactly. But when Ford builds a truck, they usually sell pretty well.
What about some of their efforts in partnering with Chinese companies, with Geely, for example? What updates might we hear from Ford on that effort?
Yeah, so they're talking to Geely about maybe using their excess capacity at their Valencia factory in Europe, which is only on one shift right now. So they could fill it up, get better efficiency from that plant, and give Geely a manufacturing base in Europe as the Chinese really push harder into that market. They're also talking to BYD about perhaps supplying batteries for hybrids. So they're in a lot of talks with Chinese automakers.
Thank goodness, for the sake of America, Keith, that this is a company that still sells V8 with a stick shift and rear-wheel drive for under $100,000. I don't think, correct me if I'm wrong, that there are any others, right? I mean, the other American competitor to this would, I guess, be a CT5V Blackwing, but that costs well into six figures and has a supercharger on it. How much does Mustang, and we're showing pictures of that beauty right here, how much does that contribute to the bottom line, or do they just do this as, their civil duty?
No, they make a lot of money, particularly on the high-end Mustangs. They introduced the Dark Horse SC supercharged Mustang at the Detroit Auto Show this year. That's expected to sell for around $90,000, a big V8 with more than 500 horsepower. So they make a lot of money on those. They obviously sell them in low volumes, but very high margins.
Well, it's a win-win for all of us, and they're patriots for doing it. Keith, thanks so much for joining us. Keith Naughton covers Ford for us out of Detroit, Motor City. Be sure, by the way, to listen to my podcast, Hot Pursuit with Hannah Elliott. It's available wherever you get your podcasts, just like all podcasts are available wherever you get your podcasts. But this is a good one. Check it out, Hot Pursuit with me and Hannah Elliott. This is Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Going to check on stocks right now, about an hour and a half into the session. The S&P 500 now putting up some gains at 69.78. It's right there at the closing high. The NASDAQ 100 up at 25,300. The Russell and the Dow gaining as well. Take a look at NVIDIA, still down, but only 0.2%. So it's not that much of a drag. Alphabet shares, on the other hand, are the biggest loser in terms of points on the S&P, down 2.25%. TSMC is up because it said sales rose 37%. So the demand is still there for the chips that they make. Netflix is gaining this even after Paramount added a 25-cent tick fee to its offer. Seems like no one cares, up 2.2%. Coke is down 2.2% after earnings disappointed, and CVS is up for the same reason. Coming up tomorrow, it's Jobs Day. Katrina Dudley joins us from Franklin Templeton.